Today we have an exciting market update straight from Tom Lee, Head of Research at Fundstrat and Chief Investment Officer of Fundstrat Capital. Tom Lee joined Squawk Box to share his latest thoughts on the markets, including the year-end outlook for the S&P 500, Bitcoin trends, and what investors should be watching right now. According to Tom, all the signs are pointing to a massive year-end market rally, and he sees the S&P 500 potentially reaching 7,500 by the end of the year. I'll first show you the clip of Tom Lee on CNBC, and right after, I'll break down my reaction to everything he said. Then we will go even deeper with an in-depth analysis of 3 growth stocks that you should consider buying for the long term. If you only watch one video today, make sure it is this one and stick with me until the very end. Hit the like button, let's get 1,000 likes on this video, share it with your friends, and leave your thoughts in the comments below. Don't forget to subscribe to the channel so you never miss the next big market update. Let's jump in and see what Tom Lee has to say.
Joining us now, Tom Lee, Fundstrat Global Advisors, Head of Research, and a CNBC contributor. Once again, Tom, looking at your last couple of appearances, whenever you're, actually it's been a while now, when you're on, I kind of hold my breath after some of your forecasts, because a lot of times I think no way, and then it's always seemed you have not been really wrong yet in any significant way. Do you ever have any trepidation, second thoughts? Do you ever get nervous about any of your calls?
Yeah, all the time, filled with doubts because, the future is very uncertain.
No one can be right off your 51%. You're like the best ever in this business. You're still bullish, even though you talked about last week, a little wobble in some stocks. Sell on the news because of China. Now, it looks like a little bit of hawkishness out of 𝗣𝗟𝗏. I don't know if that lasts.
Yeah, that's right. I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened. So if you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. So maybe...
For November.
Yeah, maybe even 250. So maybe we get to 71.
See, that's a call that I just wish you wouldn't make a call like that, right?
Well, you could
250
into 3% if that makes you feel better.
It does make me feel a little bit better because 250 points to say in November, 250 points. You're giving a time and a size.
But maybe we wobble the first couple weeks just to digest all the gains.
Yeah, that's what I saw in your notes. So initially there could be some choppy trading at this point. What's driving everything? There's still, I guess, sentiment is not positive, is it? You mentioned the wall of worry.
Yeah, I mean, if you look at it like AAII, the average sentiment this year is still minus 11.5, like net solidly bearish. That's only happened 3 other times in 35 years, all in the middle of bear markets. So investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. Over 80% of fund managers are missing their benchmark this year.
Wow. And you don't care about not having government data because does the market ever really wait for government data? Or it sort of sniffs it out, doesn't it?
Yeah.
The all-knowing market.
That's right, because, we have good Fed futures to look at what's implied for inflation. The Fed looks at the bond market. The bond market figures things out before the data comes out. I do think the inflation is probably falling a lot faster than everyone expects. I mean, you can look at truflation, and we're down to sub 2% inflation, excluding housing.
Shelter, yeah.
Yeah, and shelter is finally cracked.
Yeah. Because that CPI number was, it was just barely cooler than expected, wasn't it?
Yes, but the shelter piece is now at 0.16 month over month. That's at 2% year over year. That level would bring core inflation down sharply. And over 54% of the CPI components are now deflating. It's the highest percentage since COVID started.
It seems, Tom, that the markets have, largely because of what you're describing, moved on from the inflation watch.
Yeah.
They've kind of put that aside as maybe the forefront risk, and much like the Fed has been dragged to doing, wondering about downside risk to growth. I mean, if you just look at things like the reaction of home builder stocks, consumer cyclicals, regional banks, just to that hawkish cut by Powell last week, it seems like it's not hard to get the market a little bit uneasy about, just exactly what kind of a soft patch this is, even if we have confidence that maybe it firms up into next year. So how does that play into the overall action in the index and what you expect from the market.
Yeah, I mean, I think there is something the market's trying to figure out, which is AI is consuming jobs, but that's turning it into profits for corporates. So like profits are expanding. And then we have profit margins have actually been going up in the middle of tariffs. So how are companies able to take 70% of the tariff hit, but margins are going up? So there must be a productivity boom somewhere. And then we have, like you said, $7 trillion of cash on the sidelines, but we have high rates. And so the Fed, I kind of think, is trying to not overheat the economy. But we know that you just point out, like, housing's in big trouble. So I would say it makes sense if inflation's in a good place and jobs aren't really strengthening for cuts to happen, and that would be really dovish. So I think that sort of comes together before the end of the year.
Andrew.
Hey, Tom. Have you been reading all these stories that just been out, recently here about how the Fed is doing all of this sort of repo activity, like a lot of repo activity, and I just wonder what that really means for both the markets and maybe even for crypto. This is a ton of money. I mean, it looks like something like $30 billion just to ease liquidity concerns. This is, past couple of days kind of thing.
It is pretty typical into month end, right? That's what we are seeing. And I think that some of these numbers are also being distorted because of the government shutdown. So we know that the Treasury reserves are building because there aren't any payments being made. So it is something we're watching. But if I was to say that there's signs of bank stress, I'd also be looking for high yield spreads to be widening. And those are actually staying pretty calm.
So you figure no problem with 7,000 by the end of the year, more likely something even above that, in your view? Like what? Like 7,300?
Yeah, I mean, maybe 7,300, 7,500.
7,500.
Yeah, so we still, in December, we would build on those November gains.
See, Santoli's like, no way.
No, I don't say no way. I'm open-minded to how far bull markets can go, right? Strong years end strong. We all know about that. The one piece of it I think it's worth kind of struggling with a little bit, though, Tom, is you can look at the AAI surveys, kind of what people are saying, and then you see, equity exposures in, Bank of America private client accounts are basically at their highs, right? So people have kind of, in aggregate, been riding this to some degree. And then you see a lot of what we've talked about in the last several months of, this kind of upwelling of speculative action in non-profitable tech stocks, low-quality equities leading. That's not the Mag 7. That's like a lot of other marginal stuff. So how do you jibe that with that sense that people are still skeptical?
Yeah, I mean, one, we know there must be skepticism because if people were bullish, the institutional fund managers should have better performance. But as you know, this is one of the worst years for fund managers in almost 30 years. I think that there is also kind of problems in private markets. So I think private credit is doing terribly, and I think a lot of LPs in alternative funds, whether it's venture or private equity, are pretty disappointed by the returns, like the 5 years into now. But the stock market's done well. So I think that there is bearishness because like private equity hasn't come through and fund managers are doing badly. But you're right, the ones who stuck with public stocks are doing well.
I want you to quit while you're ahead, but I have to ask you about Bitcoin. I mean, you want to go out on a limb there too? Because it's weak again today, 107. Go below 100 or no?
Well, Bitcoin, I mean, if I look at everything since October 10th, because that was the biggest liquidation in the history of crypto, like bigger than FTX.
Like a margin call almost.
Yeah, it was like almost a miniature rupture, like a tsunami. We're only a couple weeks from that, so I think the market is consolidating. But if I look at fundamentals, like Ethereum, stablecoin volumes have been exploding, application revenues at all-time highs. So right now, fundamentals are leading price in crypto. So I think eventually we consolidate and then we rally into year-end.
Where, 150?
Yeah, I think we could still get to 150, 200 for Bitcoin, and then something like 7,000 for Ethereum.
Tom Lee opened the interview talking about the fact that he often has doubts about his calls, and that really stood out to me. He admitted he is filled with trepidation and second thoughts all the time because predicting the market is never 100% certain. But even with that, he has been remarkably accurate on significant calls. I think that honesty is refreshing because it shows that even top analysts feel the pressure of navigating these markets. He then moved on to the market itself, pointing out that despite recent wobbles from news out of China or hawkish comments from Powell, The stock market has been on a 6-month winning streak. That is a rare occurrence, something that has only happened 6 times since 1928. Lee mentioned that historically, November has been a strong month following patterns like these, and he predicted at least a 200-point gain on the S&P and even suggested the possibility of 250 points. I found it interesting how he combines historical data with current market conditions to make these projections. He even acknowledged that there might be some choppiness in the first couple of weeks, but overall, he expects solid growth. One of the most fascinating points Lee made was about investor sentiment. He noted that even though sentiment has been negative, with an average reading of -11.5, the market is still up 17%. This discrepancy suggests a potential performance chase heading into year-end, especially considering over 80% of fund managers are missing their benchmarks this year. That gap between perception and reality is something every investor should pay attention to. Lee also emphasized that the market does not need to wait for government data. He explained that the bond market and Fed futures often anticipate inflation trends before the official numbers come out. According to him, true inflation is already falling faster than expected, with core inflation including shelter costs now below 2%. Shelter itself has started to ease, which is significant because it has been one of the biggest drivers of inflation. Over 54% of CPI components are now deflating, the highest level since the pandemic started. This tells us that inflation risk is no longer the central concern it has been. When discussing growth prospects, Lee highlighted how AI is impacting corporate profits. While AI may be consuming jobs, it is boosting productivity and profit margins. Companies are absorbing tariffs but still maintaining strong margins, which suggests a productivity boom is underway. Combined with a strong market and money on the sidelines waiting to be deployed, Lee sees a favorable setup for potential Fed rate cuts later in the year. He suggests that inflation is under control, jobs are stable, and conditions could allow for easing without overheating the economy. Liquidity in the market was another topic Lee addressed, specifically recent repo activity by the Fed. He explained that a lot of this activity is normal at month-end and can be distorted by the government shutdown, which temporarily increases Treasury reserves. Despite some concerns about bank stress, high-yield spreads remain calm, indicating stability in the banking sector. Looking ahead, Lee forecasted the possibility of the S&P continuing to climb, suggesting levels of 7,300 to 7,500 by December. He also cautioned that speculative action in low-quality or non-profitable tech stocks is something to watch, even though institutional investors remain somewhat skeptical. Fund managers have had a challenging year. Private credit and private equity have disappointed, but those who stayed invested in public stocks have seen good returns. That contrast is important for understanding market psychology heading into year-end. Finally, Lee touched on Bitcoin and the crypto market. He explained that after the massive liquidation in October, the market has been consolidating. Fundamentals in Ethereum and stablecoin volumes are strong, and application revenues are at all-time highs. This suggests that prices will eventually catch up with fundamentals, potentially reaching 15,200 for Bitcoin and 7,000 for Ethereum by the end of the year. Overall, Tom Lee provided a mix of historical context, technical insight, and forward-looking analysis. His take combines caution with optimism and gives investors a clear picture of why the market might continue its strong run, despite lingering skepticism. Watching this interview, it is clear why Lee remains one of the most respected voices in market research, and there is a lot for investors to digest and consider as they position themselves for the remainder of the year. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 growth stocks to buy for the long term. First up is Dutch Bros, ticker BROS, a coffee chain that's exploding across America and quickly becoming a household name in the world of caffeine. If you haven't heard of them yet, you probably will soon. If you're on the West Coast, you've seen their iconic blue windmills spinning above their shops, a beacon for coffee lovers looking for something a little different. For everyone else, get ready. They're expanding fast, moving into new states and regions at a pace that's turning heads in the restaurant industry. Dutch Bros isn't your typical coffee shop. Forget the quiet sit-down cafe vibe. This is all about energy, speed, and fun. Their drive-through only model and energetic broistas, that's what they call their baristas, create a cult-like customer base that keeps coming back for more. People don't just like Dutch Bros, they love it. The brand inspires a level of passion and loyalty that's rare in the coffee world. That loyalty is a huge competitive advantage. Customers wear the merch, post about their drinks, and even plan road trips around Dutch Bros locations. The numbers? Dutch Bros is in hyper-growth mode, aiming for 4,000 US locations, up from just 800 last year. That's a staggering goal, and it shows just how ambitious this company is. That's a potential 5x increase in store count, a rare runway in the restaurant industry. Most chains would kill for that kind of growth opportunity. Revenue is surging, up 39% year over year. That's not just from opening new stores, but from getting more out of each location. And it's not just new stores, same-store sales are climbing too. That means existing locations are getting busier, not just the new ones. The company is shifting from franchising to company-owned stores, capturing more profit and controlling the customer experience. This move gives them more control over quality and brand consistency as they scale. Yes, expansion is expensive and margins are tight. Building new stores and hiring staff takes serious investment, and the company is pouring resources into growth. But Dutch Bros has just posted its first profitable quarter as a public company, a major milestone that signals they're on the right track. They're optimizing operations, improving efficiency, and focusing on high-margin menu items. Drinks like their signature Rebel Energy drink and creative cold brews are big profit drivers. Dutch Bros isn't trying to be Starbucks. They're not about the urban sit-down coffeehouse experience. They target a younger crowd with customizable drinks, wild flavors, and a faster drive-through experience that fits busy lifestyles. Their menu is playful, colorful, and designed for Instagram. Their real estate strategy is data-driven, targeting high-traffic suburban spots where drive-thrus thrive. They're not chasing expensive downtown leases, they're going where the cars are. Social media, they're crushing it, leveraging viral campaigns, TikTok trends, and influencers to build a modern, energetic brand that resonates with Gen Z and millennials. The stock isn't cheap, but you're buying future growth, not today's earnings. Investors are betting on the long-term story, not just the next quarter. The U.S. coffee market is worth $50 billion, and it's still growing as Americans drink more specialty coffee than ever before. Dutch Bros has a tiny slice, even with 4,000 stores. There's a massive opportunity to grab market share from older, slower-moving competitors. Their rewards program, Dutch Rewards, drives repeat business and gives them valuable customer data. It's a powerful tool for building loyalty and personalizing offers. Leadership is strong, founder-led with a CEO who knows the industry inside out. The company's culture is rooted in its small-town Oregon beginnings, but its vision is national. Tech investments, from mobile ordering to back-end systems, are setting them up for efficient national expansion. They're using data to optimize everything from staffing to supply chain. This is a classic compounder: buy, hold, and let the growth play out over years. The real value comes from patience and letting the business scale. Dutch Bros is still in the early innings, with a long runway ahead. The company is just getting started on its national journey. If they execute, this could be the next great restaurant growth story. Think Chipotle or Starbucks in their early days before they became giants. The brand, the model, and the growth potential are all there. Dutch Bros has the ingredients to become a dominant force in American coffee. For long-term investors, Dutch Bros is a name to watch. The next few years will be critical as they scale up and prove their model works nationwide. The journey from 800 to 4,000 stores could create tremendous value, not just for shareholders, but for employees and communities as well. It's not a get-rich-quick stock, it's a long-term compounder. If you're patient, the rewards could be significant. Dutch Bros could be the next big thing in coffee, redefining what it means to be a national coffee brand in the 21st century. Let's move to our next industry disruptor, scene transition. Next up is Intuitive Surgical, ticker ISRG, the undisputed leader in robotic-assisted surgery. If you've ever wondered what the future of medicine looks like, it's already here, and it's being shaped by Intuitive's groundbreaking technology. This company has transformed the way surgeries are performed, blending robotics, advanced imaging, and data analytics to create a new standard of care. Their Da Vinci system revolutionized the operating room, making procedures that once required large incisions and long recovery times far less invasive and much safer for patients. Minimally invasive surgery is now the gold standard, letting surgeons perform complex operations through tiny incisions, with unmatched precision and control. The Da Vinci's robotic arms can move in ways the human hand simply can't, filtering out tremors and enabling movements at a microscopic scale. This means less blood loss, fewer complications, and faster recovery for patients. Hospitals pay millions for each system, and that's just the beginning of the investment. The Da Vinci is a centerpiece of modern surgical suites, often showcased to attract top surgeons and patients alike. But the real genius is the recurring revenue. Every procedure requires single-use instruments, specialized drapes, and ongoing service contracts. Intuitive keeps innovating, launching new generations of 𝗣𝗟𝗏 systems with improved imaging, haptic feedback, and even more advanced robotics. They're also expanding into new areas like lung biopsies with their ION platform, opening up entirely new markets in diagnostics and interventional procedures. Competition is rising, with giants like Medtronic and Johnson & Johnson entering the field, but Intuitive's two-decade head start is a huge advantage. Their vast trove of clinical data, deep hospital relationships, and proven outcomes are tough to beat. Surgeons trust the 𝗣𝗟𝗏 brand, and that trust is hard to replicate. Their business model is a fortress, high margins, recurring revenue, and a pristine balance sheet with no debt. Intuitive's financial strength gives it the flexibility to invest in R&D, expand globally, and weather any economic storm. The stock trades at a premium, reflecting its dominant position and long runway for growth. But for good reason, this is a buy and hold forever type of company. Patients, surgeons, and hospitals all benefit from the 𝗣𝗟𝗏 ecosystem. Their data advantage is huge. Millions of procedures fuel AI and machine learning, giving surgeons real-time insights and improving outcomes. This data not only helps optimize surgeries, but also drives continuous improvement in both hardware and software, making each generation of 𝗣𝗟𝗏 smarter and safer. Surgeons can now access analytics and guidance during procedures, reducing errors and enhancing patient safety. Training infrastructure locks in surgeons, reinforcing the ecosystem. Intuitive's simulators and certification programs ensure that new surgeons are trained on their platform from day one. International markets are just getting started. There's a long runway for growth as more countries modernize their healthcare systems. Europe and Asia are major growth opportunities. Demographics are a tailwind. An aging population means more surgeries and more demand for minimally invasive options. As people live longer, the need for safer, less traumatic surgical solutions will only increase, and Intuitive is perfectly positioned to meet that demand. The benefits of minimally invasive surgery, less pain, shorter hospital stays, and quicker returns to normal life are driving adoption everywhere. Intuitive's moat is wide, and their runway is long. Their brand technology and installed base make them the clear leader in this space. This is the definition of a high-quality compounding business, one that grows steadily, reinvests in innovation, and delivers value for decades. If you want exposure to the future of healthcare, where technology and medicine intersect to save lives and improve outcomes, Intuitive Surgical is the name to know. It's not cheap, but quality rarely is. For patient investors, this is a stock to own for the next decade and beyond. The company's vision, execution, and relentless innovation make it a true standout. The future of surgery is robotic, and Intuitive is leading the way, shaping a healthier tomorrow for millions. As technology continues to advance, expect Intuitive to remain at the forefront, setting the pace for the entire industry. Let's shift gears to our final pick, the EV revolution. Scene transition. Our third stock is Rivian, ticker RIVN, a bold player in the electric vehicle space that's making waves with its ambitious vision and innovative approach. While many companies have tried to break into the EV market, few have captured the imagination of both Wall Street and Main Street quite like Rivian. Rivian isn't just another EV startup. Their R1T truck and R1S SUV are purpose-built for adventure seekers, outdoor enthusiasts, and families who want to explore without compromise. This focus on rugged, all-electric vehicles sets them apart from Tesla, which has largely targeted the luxury and performance segments, and from legacy automakers who are still playing catch-up in the EV race. The real game-changer for Rivian? Amazon's massive order for 100,000 electric delivery vans. This isn't just a headline, it's a multi-billion-dollar deal that provides Rivian with a guaranteed revenue stream for years to come. It's also a huge vote of confidence from one of the world's most influential tech giants, signaling to the market that Rivian is a serious contender. This partnership with Amazon is more than just a sales boost. It's helping Rivian scale up its manufacturing capabilities, refine its production processes, and absorb the enormous costs that come with building vehicles at scale. The experience gained from fulfilling such a large, complex order is invaluable for a young company. Of course, the road hasn't been easy. Rivian has faced significant production challenges, supply chain disruptions, and the kind of cash burn that's typical for high-growth startups. These hurdles have hammered the stock price, leading to wild swings and testing the patience of early investors. But there are signs of real progress. Recent earnings reports show that production is finally ramping up, costs are starting to come down, and the path to achieving a positive gross margin is becoming clearer. Rivian is learning from its early missteps and adapting quickly. Demand for the R1T and R1S remains strong, with waitlists stretching months into the future. But what's really exciting is the upcoming R2 platform. This new line is designed to be more affordable and accessible, targeting a much larger segment of the market and potentially driving Rivian's next phase of growth. The R2 launch was a watershed moment for the company. In just 24 hours, Rivian racked up tens of thousands of pre-orders, demonstrating the brand's strong appeal and the pent-up demand for innovative, adventure-ready EVs at a lower price point. Rivian's approach to vertical integration is another key differentiator. By building its own charging network, selling directly to customers, and operating its own service centers, Rivian controls the entire customer experience. This creates a seamless journey for owners and builds a strong competitive moat that's hard for rivals to replicate. But let's be clear, the biggest risk facing Rivian is its cash burn. The company is still spending heavily to scale up, and it must continue to find ways to cut costs and improve efficiency if it wants to survive and thrive in the long run. Smart strategic moves, like building the R2 at their existing factory instead of constructing a new one, show that management is laser-focused on capital discipline and speed to market. These decisions could make all the difference as competition heats up. The broader EV market is a massive long-term tailwind for Rivian. Governments around the world are pushing for electrification, offering incentives, and setting ambitious targets for zero-emission vehicles. Consumers, too, are increasingly demanding cleaner, greener transportation options. Make no mistake, Rivian is a high-risk, high-reward bet. The company could stumble and fail, as many startups do, or it could emerge as a major EV player standing shoulder to shoulder with Tesla and the world's top automakers. Right now, the stock is priced for pessimism, reflecting all the risks and uncertainties. But if Rivian executes on its vision, the upside for investors could be enormous with the potential for outsized returns. CEO 𝗗𝗟𝗏 is widely regarded as a visionary leader. His passion for engineering and sustainability is matched by a willingness to make tough decisions and pivot when necessary. Recent strategic shifts show that the team is learning fast and isn't afraid to adapt. For investors with a long-time horizon and a strong stomach for volatility, Rivian offers life-changing potential. It's not for the faint of heart, but the rewards could be substantial if the company delivers on its promises. The combination of a unique, adventure-focused brand, a deep partnership with Amazon, and a clear, ambitious product roadmap makes Rivian a compelling, if speculative, pick for those willing to take the risk. Ultimately, it's all about execution. If Rivian can deliver on its production goals, manage costs, and keep customers excited, the stock could be a bargain at today's prices. But if the company stumbles, runs out of cash, or fails to scale, the stock could go to zero. That's the risk and the opportunity that comes with investing in disruptive innovators. For most investors, Rivian makes sense as a small, speculative position within a diversified portfolio. It's a way to get exposure to the future of transportation without betting the farm. The electric vehicle revolution is just getting started, and Rivian is determined to claim a front-row seat. The next few years will be critical in shaping the company's destiny and the future of the auto industry itself. So, as you consider your next move as an investor, weigh the risks and rewards carefully. Scene transition. There you have it. 3 growth stocks reshaping their industries: Dutch Bros, Intuitive Surgical, and Rivian. Each offers a unique opportunity for long-term gains. The key: find great companies and hold them through the ups and downs. Want to level up your investing? Check out my Value Stocks Investing Master course, link in the description. For exclusive tips and real-time alerts, join the StocksGalore Patreon community. Now, which of these stocks excites you most? Or is there another growth name on your radar? Drop your thoughts in the comments, like, subscribe, and share for more investing insights. Thanks for watching. See you in the next one.